Welcome to the Wealth Standing Podcast. This is episode 507. Today is January 14th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. I have a real important topic to discuss and explain to you today. I've entitled this, Boeing and Intel Don't Fight Industrial Policy. This, again, is the way I'm viewing the stock market going forward in 2026. And as you know, it's been pretty much my outlook for quite a while now. First off, what is industrial policy? Industrial policy is a twofold or a two-mission strategy. It addresses not only economic policy, but also, and in my opinion, more importantly, national security. Industrial policy is the process of restricting access to those countries that want to export into our country, as well as restricting access to U.S. technology that would leave our country. A lot of times we just focus on the tariff side of it, but it's twofold. And you have to remember that restriction to technology leaving the country as well. I'm not here to argue whether Orange Taxman's policies are good or bad, or if this violates Austrian economics or destruction of free trade. Listen, I live in the real world, and I try and focus on what I can control and what I can influence. I can't make policy, but I can look at policy and I can see how I can make money off of the policy. And so, again, I'm not here to argue the pros and cons of industrial policy. I'm here to figure out what stocks or what investment vehicles I can move in and out of to take advantage of industrial policy, because it's always been here and it sure ain't getting any weaker. Okay, and let's step back and do a little review. A lot of people are calling this a tariff war, or calling all of last year, the chaos that we saw with Liberation Day being a tariff war. And you remember I did, I think, at least one episode on that saying, listen, it's not a tariff war. Tariffs are just one battle or one battleground in the Cold War that we're in now. And the Cold War we're in right now is just like the old Cold War. It's the same but different. We're not fighting so much a communist ideology like we were against the former Soviet Union. We're now fighting against statist capitalism, which has made this an economic war. So again, it's a Cold War. It's the same but different. And we're going to use different tactics this time around and different strategies than we did last time around. More so than anything, this tariff battle within the economic war is, again, a continuation of what's just always gone on. It's just a bigger emphasis now. And to all the people that think that globalization is dead, again, you've heard me say this for a couple years now, at least, or probably going back longer to the pandemic, globalization isn't dead, it's simply peaked. And this is a topic I wrote about with the robots are coming back in 2016. Whether we had the pandemic or not, whether we had Orange Tariff Man or not, labor costs in China were rising, and the economic derivatives that they had from having cheap labor have changed the equation, because that labor is no longer cheap, and in fact China is, the world's largest installation of robotics. Side note, we'll come back to that in future episodes, because ponder this question until we discuss it, but if you're the CCP, the Chinese Communist Party, and you no longer need to rely on slave labor, well, what do you do with that 1.4 billion people? I mean, hey, remember when they needed those people, they managed during the Great Leap Forward to have a famine that killed at least 30 million people. And in the early 1980s, they established a one-child policy. Again, this is when they needed cheap labor. They still instituted a one-child policy. Well, going forward, if this is the fourth industrial revolution where we're relying on automation and robotics and cobots, you don't need 1.4 billion people. But I digress. In Cold War 2.0, this economic war, we're not trying to contain China like we tried to contain the Soviet Union. We were containing the spread of an ideology. The Chinese Communist Party of today is not trying to spread ideology like the Soviets did. They're trying to gain economic control. And so we have to have different tactics. Tariffs, and more specifically, industrial policy, is the tool that the U.S. is using. And again, it's not going away. It didn't decrease under the previous administration. And regardless of what empty suit comes in a couple years, it isn't going to change. It is the long-term trend. The United States of America, going forward, is implementing control to access in terms of our markets and in terms of our technological exports. Let me side note and digress one more second. And by the way, I haven't forgotten about stagflation. I promised way back in 2025 I'd do an episode on that. Haven't done it yet. It's coming and it's going to be worth waiting for. But remember all the gloom and doom and the Federal Reserve of Atlanta, their GDP now forecast for first quarter of 2025. It was like negative 1.2% because tariffs were going to destroy the world. Do you know what the Atlanta Fed GDP now forecast is for how the year ended with fourth quarter of 2025? They're projecting 5.3% growth. 5.3% growth. Just because industrial policy can restrict trade, it doesn't necessarily put you in a stagflation environment like we saw in the 1970s. At least not if you're in the United States today. Yeah, maybe impacting Europe that way, and particularly Germany, for many of the same reasons that we saw it impact the U.S. in 1973. A lot of that having to do with the cutoff of cheap energy. But again, that's not the case for the United States in 2026. And so, listen, I'm not telling you prices are going down. I think they are going to continue to rise. But I don't think we're going into a stagflation environment. I think we're in a growthflation environment. We'll talk more about that in other episodes. But the whole crux of the industrial policy, and let's focus on the restriction to the access of selling in the United States. And again, whether taxman puts on reciprocal or punitive taxes and in the form of tariffs, and whether they're 10% or 15 or 150%, and whether the suppliers pay for it or the customers or the American taxpayer, however you want to dissect all the nonsense in the media about tariffs, bottom line is that they are effective. They're effective in bringing manufacturing, at least in some degree, back to the United States and not bringing jobs back, because again, I believe a lot of this is being done and will be done by robots and automation. But it's about control, especially over critical areas of the economy and of manufacturing. For the last more than 30 years, we've spent a generation where our corporations were juiced up with balance sheet engineering. We hollowed out our manufacturing base. It not only had detrimental effects on the economy, but even more importantly on national security. That's being corrected now. It's been being in the process of being corrected for quite a while now. It's going to continue regardless, again, of what empty suit comes into the White House in a couple years. Restricting market access is also a long-term strategy that can play out for the United States because, simply put, we are the only game in town. Now, I know you'll listen to the media. They'll talk to you about all the other markets that China's selling to. They just had a record of something like $1.2 trillion in a trade surplus. They're defying Trump's tariffs and yada, yada, yada. Listen, ignore the propaganda. And this is whether you're red team, blue team, just focus on the reality. The United States market, and I'm talking consumer consumption, which is the important part of the economy in terms of profits, because that's the final value add stage, the last mile before you go to the end user. So you're going to make the most amount of money in that last transaction. And the United States, in terms of global consumption, and don't believe me, go Google it or OpenAI it or whatever you use now, but U.S. makes up about 30% of global consumption, and I'm talking on raw nominal U.S. dollars. Ignore the nonsense about purchasing power parity. The economists, especially the modern monetary theory type people, really like to talk about purchasing power parity. But from a corporate profitability manufacturing standpoint, it's nonsense. Using that logic to equalize economies of, say, China or India to the U.S., you could draw that same conclusion to me and Elon Musk, that we have purchasing power parity because we both, eat well, and we both live in nice houses, and we both drive cars, and we both fly on airplanes. Yeah, we have purchasing power parity, but I can promise you everything Elon Musk uses and buys is orders of magnitude better and more expensive than the way I live my life, which is no different than how the average American lives, orders of magnitude better than the average person in India. Go look up the facts, ignore the propaganda and the emotionalism of it. U.S. makes up nearly 30% of consumption, consumer consumption. The reason this matters, and the reason that the increase in China exports is a mirage, and a lot of it is a mirage anyways because it's simply transshipments where something leaves China, goes to Vietnam, gets relabeled, and then sent into the U.S. to try and get around tariffs. Add up all the consumer consumption in the European Union, in China, and in India, and it's less than U.S. consumer consumption. Go look it up. It doesn't matter if you have 3 billion people. It matters how much those people are spending. And the profits and the spending is in the United States and in the U.S. market. Think of it this way. If you're making a pair of shoes, footwear, whether the factory's in Vietnam or China, you make that pair of shoes. The factory price is like $2. Now, you throw a Nike logo on there, you bring that product to the United States, you pump it up with a bunch of hype and marketing, you get some crackhead basketball player to promote it, and guess what? You can sell that same $2 pair of shoes for more than $200. Okay, the money is not made in the manufacturing of the shoe. The money is made in the marketing and the final consumer price. And this is again why tariffs aren't as big of a deal to the overall U.S. economy that everybody was freaking out about. And again, a point I made last year, that $2 pair of shoes that you're paying $200 for because it's got a Nike logo on it, a 10, a 15, even 100% tariff is not going on your retail price. It's on the actual manufacturing cost of $2. So if you had 100% tariff on a $2 pair of shoes, well, now you're paying $4 for it, or the marketer is paying $4 for it, but they're still selling it to the consumer for $200. The point here, though, is turn that around. When you hear about all these exports that China is putting into the rest of the world, and especially the, quote, global south, well, they don't compare in profitability to selling in the United States. So it's not only access to selling products in the United States, but it's access to the extremely high margins on products that are sold within the United States. So you take that $2 pair of shoes. Yeah, sure, they can go sell those shoes in Romania or in the Sudan, but do you think they're going to get $200 for them? Not in sub-Saharan Africa. Oh, they'll find a market to sell them. They'll keep their factories running. But those outrageous extreme margins go away. And they go away from companies and factories that were, questionable if they were profitable to begin with. So if they couldn't make money selling shoes that ultimately retailed for $200, how are they going to make money selling shoes for $4, $5, or $6? The bottom line is they're not. It doesn't mean that China is a house of cards that's going to collapse tomorrow, but it means that that old pre-pandemic low-cost globalization trade is over. And by the way, those markets that China is selling into because they can't get into the U.S., to the extent that those products are not transshipped back to the United States, but that they're actually landing in those other countries, well, China's facing tariffs and restrictions on those as well, because industrial policy isn't just something the U.S. is doing, it's something that all the other countries always had been doing. Europe, Africa, other parts of Asia, they don't want China coming in, flooding their markets, and dumping products that are not economical because it makes all their local manufacturers go bankrupt. So my title today about Don't Fight Industrial Policy, might as well call it Don't Fight the USA, or Don't Bet Against the USA. And that takes us to Boeing and Intel, because Boeing and Intel are about as close to poster children for industrial policy as you can get. Both of these stocks have been in my portfolio. They're long-term holdings. Boeing, in fact, going back all the way to the pandemic. And let me read to you something that I posted about when I bought or added to my Boeing position back in February 16th of 2020. It's archived at investablewealth.com, just like all my blog posts are. I rarely post, but when I do, it stays there forever. This is what I said about Boeing, and the context of this was after all those crashes that we saw, or actually two big crashes that we saw in 2018 and I guess 2019. It had to do with problems surrounding the 737 MAX. And so this is in light of what I was talking about. I said that I thought Boeing over the long term was a good investment, that it was essentially too big to fail because of the following. It's the largest U.S. manufacturer. It's the largest U.S. exporter. It's the primary beneficiary of the Import-Export Bank, which is really effectively only there to loan money to other countries to buy Boeing jets. And listen to this. I mentioned that tariffs on Airbus have now been raised to 15%. Again, you hear that? Tariffs on Airbus raised to 15%. This is way back in 2020. And I also, again, getting to industrial policy, I mentioned the pending ban on General Electric aircraft engines being sold into China. So again, example there of Airbus being restricted coming into the U.S., and example of industrial policy that restricts U.S. technology from going into China. This is going back 6 years ago. Nothing has really changed. Now, when I wrote all that, little did I know that the government would come in and totally shut down the economy, and that would, temporarily crash Boeing stock even further, and that also Boeing would have all kinds of fraud and come up on criminal charges, and then the major pullback we had in 2022, and a lot of problems happened with Boeing. But you know what? Bottom line, it has still been too big to fail, and even had you bought at that inopportune time of February 2020, just before the worst of the pandemic, the stock today is still up, I don't know, probably more than 35% from back then. Now, that's nothing to brag about over 6 years, but it just goes to show you how what, arguably is one of the most incompetent companies in the world can still survive. And they survive because of U.S. industrial policy. We don't want Boeing to go bankrupt. Now, that doesn't mean that investors won't get a bad raw deal like they did when we saw the GM fiasco in 2008. But even General Motors is still around today, and depending upon when you bought it, it could have still been a profitable trade. The bottom line on this is that industrial policy favors certain aspects of the economy. Now, is that pure capitalism? Is that free trade? I can't control any of that. But I can control where I invest. And while Boeing is, up some 35% over the last 6 years, but those have still been very rough, lean years, you know what? Again, it all depends on when you bought it and if you've added to it. Boeing stock over the last 12 months is up almost 42%. I'm not telling you to run out and buy Boeing, although I do think it's at an inflection point and could break out even farther from here. Again, pull up a long-term chart. Look at that resistance that's been built at around $260 a share over the last 6 years. And if it breaks out above that level, I think it can go a lot farther. But the bottom line is that it is detrimental to the United States to lose Boeing as a commercial aircraft builder, to lose Boeing for the defense contracts, to lose Boeing for their working with NASA. Boeing is too critical. Not to say that they couldn't fail, but they pretty much are too big to fail. That's industrial policy. That's the way it works. These are the type of stocks that you want to have in your portfolio. You want to buy them when everyone hates them. You don't know if you'll get in at exactly the bottom, but generally, a major company like this that's critical to the United States, both in terms of economic job creation and national security reasons, it's very highly unlikely that it's going to fail. So long term, it's worth owning. That takes us to Intel, another poster child for both industrial policy and incompetence. In fact, I think it would be a tough argument to determine whether the management at Boeing has been more incompetent than the management at Intel. I mean, they could probably both get an award for it. That doesn't necessarily mean that Intel is a bad long-term investment, again, because of industrial policy. The United States needs to have at least a toe in the foundry manufacturing of semiconductors. They have to be in terms of factories in the United States on our soil and with majority ownership by an American corporation. Now, that doesn't mean that we won't continue to do sweetheart deals and bring over manufacturing from Taiwan Semiconductor or from Samsung or from somebody else. But when it comes to pure play foundry and design work, Intel is very, very important to U.S. national security. And not even necessarily the company in and of itself, but just the access to being able to manufacture the most critical and necessary of semiconductor chips that are used for the military and for nuclear weapons and national defense. So it doesn't mean that Intel won't go out of business or that they shouldn't have gone out of business. I mean, both Boeing and Intel, had they not been favored by U.S. industrial policy, they would have gone out of business a long time ago, again, because their management had been so incompetent. But I think the tides are shifting. The empty suits are being pulled out of the corner office. Money is being injected. Both government funds as well as corporate funds are going into both Intel and Boeing to make their products in the United States and to keep them in the game. So going forward, just like in Cold War I, we are going to be bifurcated or trifurcated. Instead of having the Soviet bloc, it's going to be the Chinese markets. And then it's going to be the U.S. and the U.S. allies, and that's going to be, the English-speaking nations. It's going to be Japan. It's going to be some countries in Europe and in South America. And when you look at the map, who's on one side or the other, it's not going to be probably a whole lot different than it was 30 or 40 years ago during the last Cold War. It has to do with culture. It has to do with economies. It has to do with wealth. None of it's changing anytime soon. In fact, it's, everything old is new again. So, like I say, don't fight industrial policy. And another way to look at that is don't bet against the United States.